The very first sentence of the Bitcoin white paper describes this revolutionary new technology as, quote, a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution. Now, this concept of decentralization quickly became crypto's defining narrative. Replacing centralized structures with distributed networks suddenly seemed entirely possible. And as more cryptocurrencies launched with their own networks and unique capabilities, excitement about what was possible grew rapidly. However, something soon became apparent. Decentralization exists on a spectrum. Some crypto projects are more decentralized than others, and some aren't decentralized at all, even if they claim to be. And herein lies the problem.
Here's the problem.
The very concept of decentralization, which has attracted so many people to crypto, may be under threat, even when it comes to Bitcoin. Now, for context, Bitcoin is widely regarded as the most decentralized network in the world. That's because no central authority controls the network or your funds. Anyone around the world can participate, and anyone can operate a node or even become a Bitcoin miner to help secure the network. However, Bitcoin mining ain't what it used to be. Back in the day, anyone could help process BTC transactions on a regular computer and earn BTC as a reward. But as these rewards became more lucrative, competition quickly ramped up. And today, dedicated machines called application-specific integrated circuits, or ASICs, dominate mining. Each unit costs thousands of dollars upfront and even more in energy costs. And this is where Bitcoin's decentralization cracks begin to show. Put simply, the little guy has been priced out, while massive mining firms have invested billions to build operations with thousands of ASICs. As a result, Bitcoin's mining power is now concentrated in just a few companies, arguably undermining its decentralization. To really put things into perspective, take a second to consider that about a third of Bitcoin's mining pools are controlled by Foundry USA. Meanwhile, F2 Pool controls almost 14% and Ant Pool over 12%. So, a few large mining pools now account for a majority of Bitcoin block production, and that certainly impacts the image of Bitcoin's decentralization. That said, mining pool concentration is not the same as miner concentration. Pools aggregate many independent miners, granted that pool operators still have real influence over block construction. But that doesn't change the fact that almost all the ASICs used today were built by a single company, Bitmain, which is certainly something to think about. And of course, it's not just Bitcoin. Many cryptos claim to be decentralized, yet most fall short once you scratch the surface, albeit for various reasons. Many staked cryptos often have concentrated validator pools, and whales control governance in most DAOs. But why is all of this happening? Well, the short answer is that people simply don't care about decentralization anymore.
I don't care anymore.
Rather than network security, most investors focus on speed, reliability, and low costs. As former BitMEX CEO Arthur Hayes once said, quote, "A good price, good product, good user experience. That's all the majority of you care about and will care about in the future." And it's difficult to say that he's wrong. Case in point, a 2024 survey by Consensus, the team behind MetaMask, asked respondents what were the three main concepts they associate with cryptocurrency. Decentralization was actually the third lowest scoring result at just 5%. That is mind-blowing given that decentralization is literally what this industry was founded on. However, that same report suggested this shift might stem from a lack of education. When respondents were given an explanation of decentralization, over a third said the financial system, and apparently social media, would benefit from being more decentralized. Obviously, that's a massive improvement. Now, call us biased, but if more people understood what crypto and decentralization really mean, more would take it seriously. In other words, by watching this video and staying educated, you're already ahead of the curve. So go ahead, flex that big brain energy by bashing the like button and subscribe to the channel if you haven't already. And if you're looking for an easy way to stay informed, then why not join the Coin Bureau's Telegram channel? That's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. So sign up today using the link in the description or the QR code on screen now. Okay, now another crypto sector where decentralization is important but lacking is in DeFi. As you'll know, DeFi lets users do things like borrowing, lending, staking, yield farming, and providing liquidity, all without a centralized intermediary like a bank or an exchange. The problem is that many so-called DeFi protocols aren't that different from banks or exchanges under the hood. That's because many have single points of failure, whether that's a smart contract bug, an admin team with broad permissions, a weak multisig setup, a fragile governance system, or whatever else. Sometimes a mix of all of the above. In other words, DeFi is not decentralized enough. And that's a lesson the industry was forced to relearn the hard way with the recent Drift protocol exploit. Now, for context, Drift is a leading decentralized exchange, or DEX, on Solana. At its peak, Drift had around $1.5 billion in total value locked, or TVL. And naturally, this TVL declined as the broader market turned bearish. Nothing unusual there. But things took a turn for the worse on the 1st of April, when the protocol issued a warning on X. In their words, quote, "Drift protocol is experiencing an active attack. Deposits and withdrawals have been suspended." They added that, quote, "This is not an April Fool's joke." Early analysis by blockchain security researcher Vladimir S. suggested the exploit came from a private key leak, possibly linked to a compromised wallet. Initial estimates put the loss at $200 million. But as on-chain data rolled in, the picture got both clearer and uglier. And by the end, it was revealed the hackers had stolen $285 million in total. That makes the Drift exploit the largest DeFi attack of 2026 so far. To put that into perspective, hackers stole a combined $169 million across all DeFi protocols in Q1, spread over 34 separate incidents. Drift alone blew past that total in a single attack. Now, unsurprisingly, the incident sparked plenty of controversy, with security researchers dissecting Drift's architecture and questioning whether stronger safeguards could have prevented one of the most lucrative DeFi exploits in recent memory. Before long, the Drift team released a statement outlining what happened. They explained that, quote, "A malicious actor gained unauthorized access to Drift protocol through a novel attack, resulting in a rapid takeover of Drift's Security Council administrative powers. Allegedly, the attackers added a fake token to the DEX and altered its withdrawal limits. They then inflated the token's value before exploiting the protocol's borrowing mechanics to drain hundreds of millions in liquidity." Ouch. And to make matters even worse, the Drift team posted again on X on the 5th of April with a detailed breakdown of what went wrong, revealing that this attack was 6 months in the making. In late 2025, Drift was approached by a group from what seemed to be a legitimate quant trading firm. Multiple meetings took place, Telegram groups were created, and messages were exchanged. Drift team members met with the group repeatedly at various conferences, sharing insights, tools, and project ideas. The group also onboarded an ecosystem vault on Drift and deposited $1 million of their own capital, clearly aiming to build trust. But this so-called trust was just a social engineering attack. By the time the exploit hit on the 1st of April, all chats and malicious software had already been scrubbed clean. At the center of it all, though, was a multi-sig wallet requiring just 2 private key signatures. And this is an important point because while multi-sigs are meant to boost security, this incident highlighted that they can also become a centralized choke point. In any case, some experts argued that Drift could have slowed or even stopped the attack with time locks, which delay high-impact transactions. Meanwhile, others suggested that automated circuit breakers could have been used to freeze protocol activity during abnormal outflows. With either approach, Drift could have been given a crucial window to respond before funds were moved. Intriguingly, though, many critics also questioned how centralized stablecoins were able to move freely on-chain without being frozen. Many asked why Circle, the issuer of USDC, didn't intervene, since the attacker spent hours swapping $270 million into USDC before bridging to Ethereum. According to on-chain investigator Zach XBT, Circle had a 6-hour window to freeze the funds, but didn't step in. But ironically, for this to happen, a centralized stablecoin issuer like Circle or Tether would need to intervene. And for many, that's an ethical overstep, while others argue that it's the right thing to do, but well, more on all of that later. Now, the recent incident involving Drift raises big questions about crypto's broader adoption. After all, at a certain point, we need to think less about how crypto natives talk about decentralization and more on how ordinary users experience the industry and its associated risks. Put simply, the average user doesn't distinguish between smart contract exploits, admin key abuse, or governance attacks. They just see that the protocol failed, end of story. From their perspective, failure is failure. No matter the cause, the user will simply say, "This crypto app broke and I lost money." And nobody is going to want to stick around after that. The reality is that new users are often drawn to DeFi for its transformative and often lucrative potential. Yet few understand the risks embedded in some of the most commonly used tokens. And nowhere is this clearer than in stablecoins, the very lifeblood of DeFi itself. In case you didn't know, DeFi is almost entirely dependent on stablecoin liquidity. That's because stablecoins serve as the base money that powers most of DeFi's functionality and settlement, with USDC and USDT alone making up 82% of the entire stablecoin market. Now, these stablecoins are essentially permissioned IOUs, not neutral money. So, in other words, when you trade your favorite meme coin for USDT, swapping that USDT back to fiat requires trusting the issuer, Tether in this example, to honor the redemption. This creates a hidden dependency on stablecoin issuers, regulators, and even external custodians. But herein lies the real problem. These stablecoins also mean that these so-called decentralized finance rails often run on centralized liabilities. That's simply because fiat-backed stablecoins are issued, governed, and controlled by a single company, meaning they carry the same choke points that DeFi was meant to eliminate. And this isn't just theoretical. The contracts for USDC and USDT include built-in functions that allow their issuers to freeze or blacklist addresses at will, and these functions have been used repeatedly in the past. And make no mistake, those frozen stablecoins represent real money that users can no longer access. Over the years, Circle has blacklisted countless wallets and frozen millions in USDC. The most recent example happened just last month when it froze millions of dollars in USDC across 16 wallets. Naturally, this move raised more than a few eyebrows, though not for the reasons you might expect. You see, most people weren't upset that Circle froze assets on chain, but that its approach seemed inconsistent. And by far the most vocal critic has been Zach XBT, who challenged Circle by asking why these 16 wallets were frozen when, quote, they have provided absolutely zero basis to freeze all of these business addresses. Zach later updated that 5 of the 16 wallets were unfrozen. Regardless, his point was that Circle's use of on-chain data has been inconsistent. And this isn't the first time Zach has raised the issue. In late February 2025, he asked Circle's CEO, Jeremy Allaire, why Circle hadn't frozen $115,000 in USDC tied to the massive Bybit hack last year. Allaire responded that Circle only acts when requested to by law enforcement, which only drew further criticism. Zach replied asking, quote, how hard is it to do the right thing as a leading centralized stablecoin issuer? Now, of course, Zach isn't alone. Many believe intervention is justified when situations are extreme enough to warrant it. But from an adoption standpoint, this raises several questions. If DeFi's money layer can be frozen or manipulated by a centralized company, then how is it any different from a bank or payment processor freezing an account? More importantly, if DeFi depends on centralized stablecoins, Web2 hosted front ends, admin keys, and emergency pauses, is decentralization really just a spectrum? Is it merely a marketing term? Or does decentralization really exist, just not with the parts that users actually interact with? And if that's the case, then what's the point? Well, the truth is, people won't adopt DeFi or even crypto because it's decentralized or has a fancy algorithm. They'll adopt it because they want reliability, safety, and simplicity. If someone's first DeFi experience is someone flicked a switch and now I can't move my paycheck, well, that person ain't coming back. Now, by this point, you can probably see why decentralization is such a hot topic. Simply put, the more decentralized a protocol is, the more secure and resilient it tends to be. But after everything we've covered, it's worth asking whether pure decentralization is always the best choice. Our instincts may say yes, but the reality isn't so clear-cut. And nothing illustrates this better than the Hyperliquid case from about a year ago. In March 2025, decentralized derivatives exchange Hyperliquid found itself at the center of a very public controversy. The platform announced it would delist perpetual futures tied to the Jelly meme coin after, quote, evidence of suspicious market activity. According to Hyperliquid, the decision followed a user placing a $6 million short on the Jelly token using 20x leverage. The platform also said that any users affected would be automatically reimbursed by the Hyper Foundation, Hyperliquid's ecosystem nonprofit. A decision to delist Jelly was made collectively, with validators agreeing to act after determining that letting the position unwind naturally would trigger a liquidation cascade. In other words, doing nothing would have forced the protocol to absorb losses affecting innocent users across the exchange. The intervention wasn't elegant, but it was meant to keep the system running. Still, the backlash was immediate. Critics argued that forcibly delisting a market and intervening in positions violated the core principle of decentralized finance. And this sentiment spilled into Hyperliquid's Hype token, which dropped about 14% in a single day. For many, it was proof that Hyperliquid wasn't as decentralized as people believed. Just days later, though, a detailed post-mortem from Arkham Intelligence explained exactly what happened. Basically, the trader had deposited over $7 million across 3 accounts, using them to open offsetting long and short positions on Jelly. 2 accounts held $4.1 million in long exposure, while the third held a matching short. When Jelly surged 400%, the trader's short position entered liquidation, but it was too large to unwind normally. Instead, it was absorbed by the Hyperliquidity Provider Vault, or HPV. The trader then tried to withdraw profits, but found their accounts restricted, forcing them to close positions at a loss. Data from Arkham showed the trader had deposited $7.1 million in total, but could only withdraw $6.2 million, leaving $900,000 worth frozen. Unsurprisingly, Hyperliquid's intervention sparked the usual debates about whether this flies in the face of decentralization or not. Arthur Hayes, the aforementioned co-founder and former CEO of BitMEX, said, quote, "Let's stop pretending Hyperliquid is decentralized," while BitGet CEO Gracie Chen even said that, quote, "Hyperliquid may be on track to become FTX 2.0. Strong words, but not everyone viewed it as a failure. Many traders and analysts praised the platform for acting quickly to protect users and contain systemic risk. They saw that Hyperliquid faced a situation where doing nothing could have caused far greater harm to the wider ecosystem. Essentially, Hyperliquid chose the lesser of 2 evils, and it paid off. Heck, Decrypt even named Hyperliquid as Project of the Year for 2025, highlighting its growth, resilience, and ability to navigate extreme stress events, including the Jelly drama, without collapsing or halting operations. When you compare this with what happened at Drift Protocol, well, the contrast is pretty glaring. In the Drift scenario, decentralization seemed like a weakness. Funds were lost, withdrawals were paused, and no intervention came in time to preserve user confidence. But with Hyperliquid, that intervention prevented a full-scale collapse, and the market ultimately rewarded the platform for keeping the system intact. So then, by this point, you're probably wondering what all of this means for the future of decentralization in crypto. Well, after everything we've looked at, from questions about Bitcoin mining to the drift exploit to Hyperliquid's controversial intervention, a bigger picture is clearly emerging. Put simply, crypto might not be heading towards pure decentralization at all. Instead, it seems to be evolving into something closer to pseudo-decentralization. In other words, decentralized enough to satisfy ideology and branding, but centralized enough to actually function, survive, and thrive in the real world. Now, admittedly, this is a somewhat controversial take. Back in the day, decentralization was everything. Nowadays, though, many would argue that decentralization on its own isn't inherently valuable. It only matters if it drives real economic activity. A project can be perfectly decentralized in theory, but, well, if nobody's actually using it, that decentralization doesn't really mean much. But does this mean that decentralization is irrelevant?
Absolutely not.
When done right, decentralized systems boost security, cut costs, make protocols more accessible, and attract genuine user activity. However, only when these networks have real economic activity do the benefits of decentralization, like governance, censorship resistance, and resilience, really matter to the average user. The truth is, today's users mostly don't prioritize decentralization. Many are happy to rely exclusively on centralized exchanges, and most really wouldn't object when centralized actors move decisively if it means their funds are protected, even if that comes at the cost of decentralization. But it's not just users who feel this way. Regulators are moving in the same direction. Take the recently passed Genius Act, for example. It legally requires stablecoin issuers like Circle or Tether to freeze or block illicit transactions. So, if the law mandates intervention, the question isn't whether these centralized controls should exist, it's when they should be implemented. Regardless, the real question, though, is whether it's best to have fully decentralized systems or protocols with centralized safeguards that maintain trust. Maybe the future of crypto isn't about returning to pure decentralization. Maybe it's about finding a pragmatic balance, a hybrid model of sorts, where decentralized rails coexist with responsible centralized entities that keep users and capital safe. But well, what do you think? Would this new hybrid approach be a betrayal of Satoshi's original vision, or is it simply the only version that can realistically work at scale? Let us know your thoughts in the comments below. If you want to learn more about Tether's upcoming audit, then check out the video over here. And if you want to see why institutions are still bullish on crypto, then check out the video right here. Okay, thank you all for watching, and I'll see you again soon. This is Guy, over and out.